Welcome to another of Wynniatt-Husey's short information seminars on our favourite subject, which is tax. The aim today is to whip through inheritance tax to give you all a broad idea of where you are, whether you're doing everything correctly, whether you've got a problem, or whether you're okay. Obviously, tax these days is very individual, so I'm hoping that this is going to incite you into more questions, and probably those that need it to come and see me. But hopefully today you'll leave this hour-long session knowing more about inheritance tax, and hopefully being able to make some adjustments to your life to reduce what the inheritance tax bill is. So what we're going to talk about today, as you can see from our slides, we're trying to keep it as humorous as we possibly can. But my famous saying is where there's a will, there's relatives, and where there is no will, there's even more relatives. And we'll go on to explain some of that as we go through the course. So what's going to happen is I don't have any control of the mute button. Kelly in our other office has the mute button, so she's going to mute you all, hopefully except me. And when we get to the end of the course, she'll unmute you, and then anybody who's got any questions, I will answer them. Obviously, some of them will be more complicated than others, and some of them you may have to come and talk to me, but hopefully they will give you a good broad span of information. So what are we doing today? So we're going to look at what happens if there is no will. We're going to have a look to see what happens if you die intestate. We're going to look at the major things that you should be including in a will, and those sort of things. We're going to discuss what avoids a will, and that might be a little bit interesting. We're going to look at the current tax rates and the current reliefs that you can currently get from inheritance tax, so you can all very quickly work out, you know, how you are and how you're faring. We're going to look about how you can give money away, how much, how often, and what the tax consequences of giving money away are. We're going to have a quick look at the use of trusts. I mean, the whole use of trusts is a whole different subject, and will be another course in the short while, but I'm just going to show you a few ideas of what trusts can be used for, and the costs of getting into trusts, and you know, and the various types of trusts that are used around wills. We're going to have a quick look at the anti-avoidance measures. So these are the laws that HMRC and the government have brought in to try and stop us from giving away all our wealth and paying no tax. A quick look at my recommendations. Some of them are tongue-in-cheek, but they are still on my recommendations. So hopefully they'll give you an insight of what you should be doing about inheritance tax. And lastly, we're going to come on to any questions. The inheritance tax is several levels. I mean, today we're going to be doing mainly basic level stuff. There won't be any highbrow tax in here. We'll save them for whether we've got any more complicated inheritance tax situations. So, what happens when there is no will? Well, if you die with no will, or a voided will, which we'll discuss in a minute, then you're identified as being died intestate. And there is very simple rules to somebody intestate. Your money always goes in a certain direction, whether you wanted it to or not. So and it mainly goes down your next of kin, and it sort of goes down the chain and then up the chain and then across the chain and then up the chain and across the chain. But I'll explain that to you in more as we just go through the slides. So if you're married and no kids, then it's quite simple. Your spouse or your civil partner gets the lot, and that's it. That's the end of story. That has changed since 2014. So if anybody's doing wills that's doing death before 14, then it's different rules. But since 2014, the rules are that if you die with no children, then your spouse or civil partner gets the lot. If you've got children, then your spouse comes first. She will get, or he will get, or a civil partner, they will get £270,000 plus anything that's classed as personal chattel. That's the television, the car, and the carpets, the bed, and your jewellery, and those sort of things. The remainder is split, and it goes. Sorry, it is split. Ignore that one. I'll go back one. So the remainder is split between the children and the wife. So if you die and you're worth £770,000, your wife will get £270,000, or your spouse or your husband or whatever. The next 250 they will also get, and the other 250 will go to your children. If one of your children has died, it will go to their children and their grandchildren in succession, and it will follow their line. If you're not married and not married or widowed, then it goes to the children first. As I said, it goes down and down to their children. If you don't have any children, it goes up. It goes to grandparents, then grandparents, then great-grandparents. If there's no line there, then it goes sideways. It goes to your brothers and sisters and their lineage. So if they've got children and they've passed on, it will go to their children and their grandchildren in that order. And if you've got no brothers and sisters, it goes up to your mum and your parents and out through your uncles and aunts and so forth. If you die and you don't leave any blood relatives, or no blood relatives can be found, then the Crown gets it. Nowadays, that usually means HMRC, but in Cornwall, that still goes to the Prince of Wales, because he is the Crown in Cornwall. That's just a throwaway. So, hoping that you've all got wills, or if you haven't got wills, you will be hopefully going to hurry up and get one, because you'll want money to go where you want it to go, not where I've just told you where it's going to go. Okay, so major things to include: executors has got to be somebody you know, somebody you trust. These have the powers of bringing about your will. They have the power and the duty to exercise what you have requested in your will. So choosing one carefully. If you choose a professional, and if you go to the bank and they give you a free one, they will appoint themselves, then it's likely to cost a lot of money. Okay, my recommendations to people is, if you're going to want an executor, have the family do it. If they want advice, they can go and seek it where they don't have it thrust upon them. So if you've got a solicitor as an executor of your will, he will be putting a nice little charge, and I've seen £40,000 and £50,000 as a common figure as a charge to your will. Whereas you know, if you put the children as executors, they will obviously only seek the advice that they think they may need. So the next thing, when you've decided who's going to run your will, is who you're going to leave it to. Okay, very important. The bequests, who and what. I'm a great believer of leaving it as simple as possible, and we can come into that one day. But you'll see why, and one of the ways we could do it is we could attach letters to the will, which I will talk to you about in a moment. Another thing is, if you're leaving anything to children under 18, then they're going to want trustees, and you're going to want to name those trustees also in the will. So you've at least got somebody scrupulous who's looking after any funds you leave for any minor children. Your wishes for the children under 18, if you write a trust, you need to tell the trustees what your wishes are, i.e. don't give it to them until they're 90. Let them have it if they need it for education, those sort of things. And those are the letters of wishes that you would tell your trustees. Signing a will, if you don't sign a will, it don't happen. You need to sometimes stipulate who pays the tax. Usually, if there's a tax on your estate, it will be split up in a proportion to the people that are receiving the assets. But if you wanted to leave something to the grandchildren or something like that, and you said, look, I want to leave £5,000 each to the grandchildren net of tax, and the rest of the estate to my children, then your children will pick the tax bill up, not your grandchildren. So you can stipulate in the will whether you want them to pay the tax, or whether you want it to come out the residual part of the will. Trustees, possibly. Again, if the will's going to go on for a while and it's going to take quite a tidy up, then you may want a death will, a probate will, a probate trust, a will trust. And therefore you're going to need trustees to be appointed for them as well. Beneficiaries, well, bequeath beneficiaries, we've spoken about that. You know, no will's any good without any beneficiaries. Additions to the will, codices is basically another will. So when you write a will and you then change your mind, you put an appendix to a codicil to it to say, that was my will, but instead of giving Uncle Fred £500, I want Uncle Fred to have £1,000. They are additions to the will to save you having to write out a will. A letter of wishes means you can simplify the will. You can leave the will to the majority of people, but you could leave a letter of wishes, and they usually say to the trustees, but I want my wedding ring to go to my daughter, and I want my gold watch to go to my son, or something like that. So they're appended to a will. They're not law. They don't have to abide by them, but usually if somebody's left a letter of wishes, and sometimes people leave letter of wishes to tell people why they haven't left them anything, to stop them contesting the will. So sometimes a letter of wishes can be used actually to protect the will, to stop people saying it's unfair, because if you've told somebody in a letter, I've not left you anything because I don't like you, they've got less chance of being able to contest the will. Okay. Witnesses, you've got to have a will witnessed. It's got to be by somebody who isn't family, and it's got to be by somebody who leaves their name and address, who is usually contactable, to verify that it's a fair signature. You can have somebody who is a beneficiary of the will sign it, but it's better if you don't, because then if somebody's contesting it, they can't contest it to say that it's an unfair will if you haven't signed it, if somebody else has witnessed it. Okay, so one of the most important things about inheritance tax and wills and everything else is that a will can be changed up to 2 years after death. Why is that important? Well, if you wrote a will now and then survived for another 20 years, it might be completely different circumstances. And if you write a will at 60 when your children are in their 40s, you know, they'll quite happily have the money. However, if you live for another 20 years and their children are now in their 60s, they may be doing their own inheritance tax planning, may not want the money you just left them, so they can change the will and leave it go directly to the descendants to avoid getting trapped in their inheritance tax pool. So it's a very important thing to people to remember that obviously if it's your will, you won't be around to tell everybody, but you know, wills can be changed up to 2 years after death, provided all beneficiaries agree. And that's why I'm telling you to keep the will as cheap and as simple as possible, so you don't have to go and find out who Uncle Tom left his estate to find out, you know, whether that you're allowed to change your will, because it could be quite beneficial. Okay, so what voids a will? So, well, the first thing that voids a will is not having one. Second one is fraud. Okay, if somebody believes that a will has been made up dishonestly or with coercion, I think coercion is the next one. This is where, you know, was the person of a sound mind when making a will, and was there undue coercion for them to leave it in one way or the other? And in both those cases, you would apply to the courts to have the wills voided. The next one that voids a will is no signature. If you have no signature on a will, then it is not worth the paper it's written on. And if you've got no witnesses or improper witnesses, that also voids a will. So choosing the right person is important. A new will. If you write a new will, it automatically voids the old will. Okay. My personal point of view is if you've got an old will, get rid of it. Okay, because if you've left somebody everything in their old will, and then they find it and then find you've got a new will a day before your death, they will contest it. And they will say, no, they must have been coerced because they were going to leave everything to me. So if you've got an old will, get rid of it. Just leave a new one. If it's your clear intention to void a will, so if you try to rip it up, or if you've written a letter to say, actually, I don't want that will, that's why if you look at most wills, it says this one replaces all other wills. Okay, so all other wills are replaced. So if your clear intention to void a will, then it will. Okay, and the important one is marriage or civil partnership. So if you get married after you've already written your will be void. It will be cancelled, and we will go back to the slides I showed you earlier about, and if there's no children, then your new wife or your new husband will get the lot. So if you're getting married, or if you know somebody's getting married, especially if they've got children or stepchildren, that they must remember that the day after the marriage they need to go and get somebody to write a new will for them, because their current will is void. Where are we now? So we're going to go on. I hope I'm not going too quick for everybody. As I say, we'll take some questions at the end. So we're going to go through now the rates of taxes and some of the well-known reliefs that you should be using as much as you possibly can. Okay, so inheritance tax is 40% on anything that hasn't got relief. Okay, So I'm going to tell you the reliefs in a minute, but you know, whatever's left is going to have a 40% tax charge. Okay, and that's it. You know, so if your estate's worth £1 million, you know, you're going to be paying 40% of some of that, maybe, on what I can't get you reliefs for. So reliefs. So the rates of tax is quite straightforward. The reliefs are a little bit more complicated. Okay, so everybody in the UK that is a UK taxpayer or a UK domicile will get £325,000. Okay, and again, if you are married to a UK domicile, you will also get their £325,000 less anything they have left elsewhere. So if your spouse leaves everything to you, you then have their allowance as well with everything they've left you. So you've now got £650,000. If in their time they actually left some to the children, so they left half of the allowance to the children, you would only have half of their allowance now, but it would be that half the current rate, not half the rate in the year that they died. Okay, but that's what I will work out when we're sorting out the inheritance tax. If you're married to a non-domicile, that's a person that's only going to be taxed on UK income, then they only get £325,000 worth of allowance. Okay, so that is well worth a conversation. I don't want to spend the next 4 hours telling you the differences between domicile and going through the cases. Basically, somebody who's domicile, if they are born somewhere and they choose that to be their place, or they later move somewhere and they choose that to be their domicile place. So if they have a house, a home, a family here, then it's more likely their domicile is going to be here rather than the country in which they were born. But as I say, if anybody's got anything to do about domicile, that's much more of a personal conversation than it is on a short course like today. So second one, it's a new one that's to us. It's about 5 or 6 years old now, and this is your main residence relief. Now, if you've had a main residence or you've got a main residence when you die, and you've got to leave it to your direct descendants, so going downwards only. So that's children and grandchildren, great-grandchildren. And you get either £175,000 or the value of your house, whichever is the lower. So if your house is worth 200,000, then you'll get £175,000 worth of relief. If your house is worth 150, you'll get £150,000 worth of relief. If your spouse or civil partner has died first, not use their allowance, even if they died before this rule came in, you can still claim their allowance as well. Okay, so again, so if your house is worth 350, you're not going to pay any tax on it, providing you've left it to your direct descendants. If it's only worth 300, then there's no tax. If it's worth more than 300, then we're down to using some of your personal allowance and so on. So very quickly, a couple could leave £1 million without having any inheritance tax with writing a good will. Okay. So any amounts that you give to your partner is exempt. Okay, so I've told you about the personal allowance for gifts to spouses that are not domicile. That's only £325,000. But if your spouse is UK domicile or your civil partner is UK domicile, then any bequeaths you leave to them will not be subject to inheritance tax or capital gains tax or anything else like that. There isn't any talk about changing this. It's a very useful thing. And you know, so really a married couple should only be looking at tax on the second death if they structure it right and they leave it to each other. Again, that's down to personal conversations with me, how you want to leave it and how best we can use some of these allowances. Okay. So if you've got 2 million, then if you leave $1 million to the children and then $1 million to your partner, apart from your partner killing you, you will still probably avoid some inheritance tax. Okay, that's not right, is it? Because you can only leave 500,000 because your other half will still be alive, so you won't be able to use those allowances. So you'll only be able to leave £500,000 to the children, and then $1.5 million to your spouse. So some of the smaller reliefs. So a 3,000 gift per person. That's per person giving the money, not the per person receiving the money. So you can't give lots of £3,000. You can only give one lot of £3,000. Or you can give 2 lots of 1,500 or 3 lots of 1,000. Very useful. That doesn't count as ever being in your estate. And if you haven't given last year's, you can also give last year's, but you can't carry back any more than that. So, you know, so if it's a couple, you could give away up to £12,000 this year if you didn't give anything away last year. And that's a straightforward gift, and that just falls off the radar as far as inheritance tax is concerned. The other one is, the idea is you can give £250 per person per year on top of the £3,000. And it's really just for people to give away, the revenue call it birthday and gift monies and that sort of thing. But that's really what it is identified for. Okay, £5,000 per wedding gift from mum and dad to their children. This is given at the time of the wedding, and it's each. So mum and dad can give 5,000 each, and mum-in-law and dad-in-law can give 5,000 each if they so wanted to. Now the next one is regular gifts out of income. This one's a little bit more complicated. The amount you can give, it has to be regular. Now, when they first brought this legislation in, their idea is when the grandparents said, oh, well, if you can't afford for young Johnny to have piano lessons, we'll pay for them out of our pension. Okay, that's what it was originally for. Or, you know, you can't afford school fees, I'll pay for it out of my private pension or whatever. Now, nowadays, the amount has no upper limit. Okay, as such. The only upper limit is it's restricted to your income. Now, it has to be regular gifts out of spare income. So you can't earn 100,000 a year and give £100,000 a year away. It has to be the spare money. So if you live on 50,000 a year, then you can use your other 50,000. It has to be regular. Now, regular might be once a year, but it has to be seen to be regular. But it'd be better off weekly, monthly, or something like that. So if you wanted to, if you got big pensions coming in and you wanted to get rid of some of that monies, then you could. But it's to stop, the legislation is to stop people actually giving all their income away and living on their savings to bring the savings portfolio down. That is not what this was designed for. But at least you can stop your pot from getting bigger. Okay. Investments in qualifying shares. Qualifying shares are trading companies, and they have to be non-quoted on the stock market. They can be on the AIM market, or they can be in your own companies or your family's companies. The the actual working it out, okay, there is all sorts of there's all sorts of caveats and excluded items and rules for whether a business qualifies or not. So much so that for qualifying shares and qualifying businesses, hopefully that's the next one, I'm going to do a separate course. So I'm going to do, so those people that have got a business or shares in a business later on this year, I will do a course. If it's important, somebody wants to talk to me, I will talk to them. But it's a good hour conversation just on that particular topic. But if you've got a normal trading, it's got to be a trading company. It's got to be a trading company, and you've got to hold shares in it, and you've got to hold them for at least 2 years, and then normally most of that estate will be exempt from inheritance tax. Okay. So money's given away. We're going to come on to money's given away in a minute. But if you give money away, if it's more than 7 years, it's outside your estate. Okay. If it's given into trust, then that's a whole different ball game. But if you've given somebody some money to help them on the property ladder, providing you live for 7 years, then that will fall outside your estate. What else have we got? Business property relief, that's the same as investment qualifying shares. If you've got a controlling share of a listed company, i.e. you are Robert Maxwell or somebody like that, although he's dead now, then you would still get business property relief. Okay. I don't think I've got any clients who actually have the controlling interest in a quoted company, but I'm trying to be as complete as I can. Agricultural property relief, business property relief. So if you've got a farm or you've got farmland, then it's possible that after 2 years or 7 years that could be exempt. Again, lots of caveats, or lots of people trying to use this to hide. Mr. Dyson is currently buying out most of Herefordshire and Lincolnshire to try and hide his wealth. So there's lots of clauses in here, because you could even get away with some or all of the family farmhouse. But I'm going to have to do that on a separate course. It is long-winded, and it's not for today's today's conversations. Obviously, if anybody asks me any questions afterwards, I will answer them. Pension pots. If you haven't used your pension and you're on a drawdown pension, or you haven't even drawn it down, or you've only taken your 25% out, whatever is in the pot that's left. Okay, providing that your IFA, and it's not for me, but the IFA has set it up right, and that's got to be worth a conversation, then that pot will not hit the inheritance tax pool. Okay, so that will go straight to your descendants. They may pay tax getting it out, as you would pay tax getting it out of your pension, but it won't go in the inheritance tax pool. It won't get the 40% inheritance tax. Then they can see what they can draw down, and then they will be taxed at the relevant rate when they get their monies out. Okay. If you're under 75 and you leave it to your spouse, she gets the whole lot tax-free and gets it all paid out. So again, that's maybe useful tax planning rules. If you've got a pension pot, and you've got other earnings, other savings, you may want to spend your other savings and leave your pension pots. But I'm not an IFA. That's a conversation that you would need to have with somebody who is in financial services. So giving money away. Okay, so in order to qualify, you've got to give it away. That might sound silly, but lots of people try and give things away and then hang on to it, okay? And not necessarily with money, but more over the family house. So we'll give the family house away, but I'm going to carry on living in it until I die. Well, have you given it away? No. So there's quite a lot of legislation which we're going to talk about towards the end of the slide to stop you from giving something away and still using it. But if you give it away, then, and you give it away as cash, then once it's 7 years, it is tax-free. If it's within the 7 years, okay, it becomes what we call a pet. So it's potentially exempt transfer, i.e. it will be nil after 7 years. Now, I'm going to go on in a moment to tell you about taper relief, okay? Please don't get excited with taper relief, because if you give a gift less than £325,000, the Inland Revenue put that as first gift. So that then goes against your inheritance tax banding and therefore never gets out in the open to use your gifting, okay? So there is taper relief available, but they would only apply if you're going to give large sums of money away, okay? And these are the years. So you get nothing for the first 3 years. So if you give £1 million away today and die in 2 years and 364 days, the whole lot still gets walloped for inheritance tax. 3 to 4 years, you get a 20% discount, 4 to 5, 40%, 5 to 6 years, you get 60%, 6 to 7 years, you get 80%, and I'll keep telling you, after 7 years, it is all out. It's all exempt for inheritance tax. So the best thing to do is give the kids some money and say, you better look after me for 7 years, otherwise you're going to have to pay some tax on it. Okay. If you give it into a trust, then you will pay tax. It's a chargeable lifetime tax, and so it's not a pet, it's a CLT, and you will pay 20% tax on anything above your inheritance tax rate. So if you put £350,000 into a trust for your grandchildren, then you will pay 20% tax, or your trust could pay the 20% tax, whichever way you want to do it, on the remaining 50,000, 25,000. That's a straightforward tax charge, and that tax is then deducted from the tax bill at 40% when you die. So if you gave away £100,000 that was chargeable, you'd have to pay 20 grand. If you died tomorrow, then you would have to pay the state would have to pay the other 20,000. If you got to 7 years, then of course you wouldn't pay any further tax on it, but you don't get the 20% back, okay? The 20% is the tax man's already spent, okay? So you only get what's left from the estate. So that's what that sort of says. I hope I'm a bit clearer than what it's written down there. So if you put money into a trust, you will pay tax on it if it's above your banding, and that could be offset against your inheritance tax bill if there is any. Okay. So that brings us on to trusts. Again, I hope I'm not going too quick for everybody. You're all making lots of notes. So trusts, we can set up trusts before you die, or they can be written into your will, or your will, and or your kids can change the will and create a trust as long as they do it within the 2 years. The types of trusts are interest in possession trusts. I'm going to whip through these and then I'm going to explain will trusts and discretionary trusts. Okay. An interest in possession trust is one that's usually written into your will. Okay, and that's normally when you say, I want my spouse to have the family home for as long as they die, as long as they live, but when they die, I want it to go to my children. In marriages in modern day society with many second and third time round marriages with lots of kids on lots of sides, this is being used quite often to allow your new spouse to enjoy a family home, but then your share of the family home then to go to your children rather than their children, and so on. So there's an interesting possession trust. Will trust, that's a trust that either is set up in the will, i.e. you say, I want my worldly goods to go into a trust for the grandkids, and that's a will trust. Or it could be one that your estate is very complicated and it goes into a trust until such time as it's been got probate and it's been and the executors has issued or discharged all the proceeds. It could operate under a trust. Quite often, if there's a trading company or there's property, land and buildings, it will go into a will trust so it can continue with the way it is until such time as the houses are sold or whatever. So those are the two types of will trust. Discretionary trust is by far the most common trust. And what a discretionary trust is basically you leave trustees and you leave them, although you can give them a letter and say what you'd like them to do, you give them carte blanche to do what they think that you would like, is the normal process. So your trustees will try and work out what you would have done if you had still been alive. They may not, they do what they like, but normally if you get a good trustee, they will try and second guess that although you said young Johnny couldn't have any money, he's done really well in his exams and he wants a new car and you may want to contribute out of the trust. That's what a discretionary trust allows you to do. You don't have to dig the body up and ask them. The trustees have full powers to discharge the assets as they think fit. Obviously, if you make your kids the discretionary trustees and the beneficiaries, they'll just wind the trust up and they'll spend it. So maybe having two separate different people as beneficiaries and trustees is usual. Okay. The use of trusts. Wills could have if you set a trust up, there's a tax creation, which I've discussed here about. Any income they create, they'll pay 45% tax. However, if it's going to minors, they may be able to claim that back if you distribute to them. Again, this isn't all about trust today, but I'm just trying to give you a flavour. They will pay capital gains tax at 20 or 28%. If they're more than 10 years, then anything above £225,000 will get a 6% or up to 6% charge. And if you take money out of a will, there will be an exit charge on the monies coming out as well, and that could be up to 6% also. Okay. Uses of trust. Well, I told that. So it's minor children, protecting assets, so that's your interest in possession trusts. To avoid future inheritance tax. If you've got a farmhouse or a house and you leave it into trust to go down the family line, then it only pays one lot of inheritance tax, because of course the next line don't get it, it stops in the trust, and the next line don't get it, it stops in the trust, and the next line don't get it. Whereas if you leave it to your kids and then they leave it to their kids, it keeps coming back into the inheritance tax pool. So if you've got a family heirloom or family asset and you want it to go down the lines, then leaving it in trust could be a potential way of avoiding future inheritance tax. to protect assets. So that is to stop assets being sold if you don't want them to be, to stop in-laws. So if you leave your house in trust, with ultimately it's going to your great grandkids, then if your grandkids marry, they don't have to get divorced, they don't have to shell out half the proceeds of the house because it's still in trust. So a lot of lawyers will talk to you. I will tell you they're very complicated trusts, but a lot of lawyers will try and talk you into a trust, because they want to be the trustee and they get fees from it. Yes, I am an old skeptic. But they will try to push you that way to say, well, actually, you know, what happens if your son or your daughter divorces? You know, they could have some of the money. I did say this to a couple one day, that they got a son and his wife, no children. And I said, if she married him, if she divorced him, she'd get half of everything. And they said she's entitled to it, living with our son. So who knows? That's personal, and it's up to you. But I mean, it is something that you could think about. Okay. So hopefully you're all with me. We're nearly there now. We're getting through the slides. And I'm going to recap on what we've gone through. So you're going to have a chance when we go through our recommendations to write down some of the important things you should be doing. But some of the anti-avoidance measures, okay, is, and I'll go through this, there's three major ones, which is the pre-owned assets, the gifts with reservation, and the settlement anti-avoidance legislation. And these keep getting tweaked, which is why they keep coming in the Finance Act every few years. You will see they keep tweaking them. But if I start with the last one first, the anti-avoidance settlements, that means if you give away money, and you give away money to give away income, then you will be taxed on the income. Now, that's a mouthful. I'm going to explain it to you. If you've got minor children, for example, and you've got money in your building society and you give it to your children, so they don't pay tax, do they, until the first £12,500. But that's a settlement. That is classed as a settlement for tax purposes, and that interest will fall back on your own tax return. Okay, it would like same as if you give a child dividends, things like that. You have given them a source of income, and it's anti-settlement. So that one's not big on today. It's just a warning that if you are going to give stuff away, you've got to watch about trying to give away sources of revenue. Okay, so going back to the top, pre-owned assets. Pre-owned assets is basically if you had something and you've given it away, but you still enjoy the benefit of it, then you could be taxed on the benefit. So if you give away your family home, but you continue to live in it, you will get caught up with the pre-owned assets regime, and you will be required to pay income tax on the benefit of living in your own house. Okay, so giving away their own house, and I'll tell you some more worse things about that at the moment. But this is also to stop you giving away the family yacht and then spending each summer going around the Med. Again, you've got to pay benefit in kind on the asset's value, which is 20% of the original list price per year. You pay tax thereon. Giving away the family Rolls Royce, all sorts of things. Trying to give away the Van Gogh on the mantelpiece. Again, if you've still got it, you've not given it away, you should pay pre-owned assets. Okay. The next bit is the gift with reservation, which is the same sort of thing, different part of the Act and different things. Now, this is giving something away but not giving it away. So you give it away, but you reserve the right. So again, if you give a house away, but you to reserve the right to live there, then you're not giving it away. And under the Gifts with Reservation Act, they then say, well, actually, you didn't give it away, so we'll put it back in for inheritance tax purposes. Now, what's happening to a few people who have given their family house away because a mate down the pub told them to, certainly wasn't me, the revenue are coming along and saying, well, first of all, the care home fee people are coming along and going, don't believe that, you can still pay the care home fees. Secondly, the tax man says when you die, I'll hit the estate for your underpaid benefit in kind taxes for the last 10 years. Also, I'll disallow it, so I'll have inheritance tax on it. But also, it was transferred to the children 10 years ago, so when they come to sell it, they'll end up paying capital gains tax on it. So if you know somebody who's given a house away, they may need to sit down, have a strong drink and come and talk to me, because that is not good news. So that's anti-avoidance. It's basically, in a nutshell, it's to stop you trying to abuse the system. So trying to give something away, but not give it away, to try and get the best of both worlds. Okay. So our recommendations, okay, or my recommendations, okay. So make sure you have a good, simple will. Okay, I think I've demonstrated that, the effectiveness of having a nice, easy will, and in most cases, leaving it, spouses leaving it to each other and leaving it to the kids is the best wills in the world. And then telling the kids that if anything happens to you, come and talk to me. We'll see if we want to change it, see if we want to alter it, see if we want to save monies. I mean, I'm altering wills quite often for different reasons, and it's quite an easy process and doesn't cost a lot of money to do. So a nice, simple will. My next recommendation to all you out there is spend it. Okay, if you can, spend it. There's no point living like a hermit for the kids. The kids, they'll soon have the Aston Martins. Don't you worry. So if you can spend it, then enjoy it. That's my recommendation. I'm sure there's going to be something left for the kids anyway, if they deserve it. Stick it in a pension. Okay. Again, I'm not an IFA, but for inheritance tax purposes, it is well worth looking at a pension. Okay, because you've got the flexibility. Because if you leave it alone, you get inheritance tax relief. If you take it out, then you can take it out if you want to. But don't start sticking lots into a pension if you're well below the age of 55, currently going up to 57 in 2027, I think, or 2026. But if you're only 30, putting it into pensions is not much good news, because by the time you get there, 57, might be even 70 by the time you get there, and getting your hands back on it might be not good news. But for inheritance tax purposes, currently, they're great things. And I say currently because rules change every 5 minutes in my world. Do a Ken Dodd, get married. Okay, don't know whether you all read about Ken Dodd, who got married to his lifelong partner for 30 years, 2 days before he died. Okay, why? Well, for inheritance tax purposes. We all know what Ken didn't like paying much tax, so he certainly wouldn't want to pay inheritance tax. That was obviously some advice. I don't give family advice, okay? I'm not telling you to get married, but I am recommending that if you are in a relationship and there is an inheritance tax bill looming, do consider a marriage or a civil partnership in order to get around the inheritance tax. Okay, give it away, okay? Yeah, give it away, but never give away more than you're going to need, okay? Because if you give it away to your children, give them back. There's no good giving away £500,000 and then going 3 years later saying, can I lend 10 grand? Because the answer is going to be, we ain't got it. It'll be spent. So giving it away, fine, but only give away with my help and guidance, only give away what you can and how you can, and what you're not going to need. Okay. Make sure you use all those reliefs. So make sure you're giving your £3,000 a year away, gifts to marriage, gifts out of income if you can. You know, all of those things. You know, they're there. You know, 250 quid for Christmas presents for the grandkids. They'll love it. They won't give it you back. They won't turn their noses up at it. So trying to use all your allowances, your reliefs. You know, they're not big, except gifts out of income, but you know, it's still saving money. You know, 40% is your tax rate. If you give away £3,000, you've just saved 1,200 quid. You know, how's that for tax saving? You know, it's you've got to look at it. Okay. Independent financial advice. These are business. These are buying into shares on the AIM market. The advantage of buying in shares on the AIM market, well, better than buying them from the plumber down the road, because who knows who's ever going to buy them back from you from the plumber down the road. But with the AIM market, they've got a value. The great thing is you only have to live 2 years, providing the AIM product you buy is a trading company. There's lots of businesses out there that do like venture capital trusts. So they will set you up a portfolio of lots of little bits of AIM market products, and this, that, and the other. The advantage of that is it's got 2 years, not 7 years if you give it away. And secondly, if you do need it, you can sell your assets sell your shares, and you can draw some. Okay. Whereas if you give it all away, you can't do that. The disadvantage, of course, is AIM market. So it's on the stock market, or it's on the alternative investment market. So products can go down as well as come up. Okay. So, you know, careful financial advice when you're buying an AIM market. I'm talking about tax today, not financial advice. But, you know, even if they lose a few percent, if you save 40% tax, you know, if I'm going to see somebody who's 96, got £1 million in the bank, you know, it might lose. If it loses 10% and she lives for 2 years, you know, it's gained 30%, hasn't it? And, you know, you're going to have to do quite well out of an investment to save that. So AIM market products, look at them, talk to me about them. That's what I'm here for. But they are a way of being able to maybe getting money away to one side. Okay. Leave assets in your business. Moreover, leave your business. Don't sell it. Don't shut it down. Transfer it. We can transfer, again, this is probably for another day, but you can actually transfer the business to your next of kin, pay no capital gains tax on it, and still have inheritance tax relief. Okay, so leaving assets in your business and not shutting your business. You know, a friend of mine's just sold their business for 3 million. And the first thing I said to him is, whoops, you've got a tax bill if you die. And he went, oh, not very well. He's going to be even sicker if he does die, and ends up what 3 million would have got 100% inheritance tax relief, is now looking at a potential bill of 1.2 million. So before you're selling your assets in a business, again, take some advice. Okay, don't retire. That's what I say. That's my recommendation to you all. They won't let me retire, so why should you lot? I mean, if they let me retire, I'll let you. But don't retire. Keep the business going. Leave your assets in your business. Get your properties in there. Trading properties, maybe even some investment properties. Again, it's a longer conversation. But certainly look at keeping the family business or the family farm going down the line. And you've got to remember one thing: inheritance tax does not pay capital gains tax. Okay, so when you die, whatever you've got left will be valued. Okay, at the new value your children get that. So if you've got shares in Vodafone and they're now worth £1 million and you paid 200,000 for them, you know, you will pay inheritance tax unless you can use some of your allowances up, but your children get them at the new value, the £1 million. Okay, so if they sell them the next day, they don't pay any capital gains tax. So if you've got a farm or an off license and the building's in the off license and you qualify for 100% inheritance tax, they get it at the new value. If they sell the business the day after they inherited it, they won't pay any capital gains tax or inheritance tax. Okay, so that's quite good advice. You know, and one of the important things is keep talking to us. Okay, your life changes all the time. You know, you come and tell me about your accounts, you come and ask me about whether you should buy a new buy-to-let. You know, maybe you should say, by the way, Alan, just have a quick look at my inheritance tax for me. Have I got a problem yet? You know, and you know, or you know, things are changing. You know, my wife's left me. You know, whatever. You know, they change your inheritance tax. It might be a few-minute conversation. It might be me saying, no, you're still okay, or it might be me sitting down going, book yourself in for another course. We've got another chat. We've got to talk about it. But there's nothing wrong if I'm seeing you or one of my staff seeing you once a year to discuss your wealth of your tax bill, then we should be looking at your inheritance tax bill at the same time. Careful consideration must be used when using a professional. I did intimate this earlier on. You know, a lot of people, a lot of professionals out there are very honest and very good. A lot of them, they give you advice that helps them probably better than helps you. You know, a lot of banks will give you a free will. A lot of charities will give you a free will now, but they write themselves in executors. They will charge you will, and of course they want to be executors so they can get the donation that you've left them pretty quick. And I've been told that they are fairly ruthless as well in getting that money. So just make sure that the person that you're engaging is on your side, not their own or HM Revenue and Customs. Okay, so I'm hoping Kelly is going to unmute you now. No, yes.
Yeah, she's unmuted as Alan.
So you're all starting to come off unmute. I don't know whether you're all going to come off unmute. So I will take any questions. I will try not to, if it's going to be personal, then I will refer you to talking to me, not on Zoom link. This will be available for download for our clients and yourselves at some point if anybody wants it. So don't ask me something that would embarrass you, but you know, you can always ring me afterwards. So has anybody got any questions? No. Did everybody enjoy the course?
Yeah, it was good. Thanks, Alan. It's Helen.
Right. So, question, Caroline.
Well, yeah, we may have to come and see you because it's really complicated situation that we're in with my parents.
Yeah.
They own a farmhouse. It's not a working farm. It's just literally a farm with 3 fields, and it's gone onto the town plan. So they've got builders knocking on the door every day offering them money to buy the house, to knock it down, to build houses on it. Now they've had some advice that if they get the planning permission themselves, rather than the builder get the planning permission, then they can probably sell it for a lot more money. So am I right in saying they can't give the house to us, to me and my sister now, and hold it in trust and still live in it?
No, you'd have to move them out. Okay. They could, you would have to move them, but if you're going to get planning on it, they may have to move anyway, but you'd have to move them. The thing to remember, the most important thing to remember is that if you give something away, it's the value at the day that you give it away, okay, not the value it's worth when you die, okay. So if you're giving away qualifying assets, and then they become unqualifying assets, then, you know, so if you give away your farmland, and if they've owned the land for more than 7 years, they will get inheritance tax relief on the land as it's farm, but only get it at the agricultural rate, okay? So they won't get it at building rate. But if they'd have given you that land 3 or 4 years ago before planning come on it, then you would all be sitting pretty. If they give it to you now, obviously they will pay capital gains tax on the current value. Well, that might be a lot lower than what it is. The thing to watch is to remember that although you don't pay capital gains tax and inheritance tax at death, you do if you sell the asset or give the asset away before. So like my friend who sold his business, he's going to pay capital gains tax on the sale of his business, and if he dies, he'll pay inheritance tax on it as well. Okay, so what you've got to be careful with your parents is if they do give you the farmhouse and you end up paying, you end up paying capital gains tax on that, and then they die within the 7 years, and it gets added back for inheritance tax. They pay the tax twice on it.
Yeah.
Okay, so not being rude, but I think you're a bit far down the line to do any serious planning.
Yeah.
Okay, but come and have a coffee with me, and we'll talk about whether we can get any agricultural relief or anything else on it. But it's going to be a bit tight, I'm afraid. You might be better hanging on to it, paying the inheritance tax, and riding a wave out after that. Okay, it could be that they don't build on it, so it goes through the inheritance tax lower rate if they're likely to not be around for very long, and then it goes through the inheritance tax, then you build on it. Don't know. There's a couple of ideas there, but I think that one needs to be chewed a bit more, Caroline.
And then me and Andrew, if we've got surplus monies, I'm 50 in 2 weeks' time. Are you saying not to put it into a pension at this age, or
no? Well, I mean, you know, if you can get the tax relief on using pensions, then that's great. If you can use inheritance tax as well, that's even better. Okay. My personal view, and it's only my personal view, is that, you know, you should be putting spare monies into pensions rather than all your money. Yeah. So if you've got spare monies, especially if you've got spare income coming in, then that's good advice. Look at a pension, put some money in it.
Pensions over property. Is that a better?
Listen. It depends on what you feel like. Yeah, they all have advantages and disadvantages. Yeah. If you're good at properties, then maybe you want to put it into property. If you're not good at properties, leave them alone and get somebody else to have all the hassle. I mean, at the moment, pensions get all the good tax breaks, and properties get all the bad ones.
Yeah.
It's hard. It's very much on an individual base. It might be a case of doing a bit of both if you can afford it.
Yeah.
Okay.
Thank you.
Anybody else?
Can I ask a question? I'm the relative of the Marshalls, right?
Yeah.
And it's about me and my wife has got a property as our main residence.
Yeah.
We're planning to live in a granny annex with Marshall.
Right.
So a certain sort of local council tax situation, if that is main, that annex will be used as our, whoever lives in that, the main residence.
Okay.
So I hope this is not avoiding things, but I was thinking that if my wife or myself sort of live in there as a main residence, would it affect the main residence allowance on inheritance tax and or the capital gain tax if it comes to selling it?
Okay, so I don't know whether I've got all your personal circumstances, so just you have to bear with me, but because it's your main residence, then currently there is no inheritance, there is no capital gains tax.
That's right. Yeah.
On the disposal of your house, so that's a tick in the box. Okay. If it's an annex, then it's considered to be the same part of the house. Okay, and usually the council are quite sneaky by this, and they'll only make it an annex, so it can't be a separate dwelling, and therefore you can't do any fancy tax planning with it. Yeah. If it was a separate dwelling, if you can get it as a separate dwelling, and you know, a lot of the wealthy people, they move out to the lodge or the gatehouse and leave the house to their kids. That's quite doable, and that's something that we need to be looking at. Again, you know, that's well worth coming and having a cup of coffee with me. But I think that in your case, you might find you get stitched up, and if I can use those words, you'll get stitched up by the council, and it'll still be your main residence, and that will cause you all sorts of problems.
Okay. Yeah. So okay. Yeah. Thanks.
But do come and have a chat with me. That's what I'm here for.
Okay. Yeah. Good. Okay. Yeah. Thank you.
Okay. Anybody else? Good. Well, I want to thank you all for attending this meeting. I hope you found it useful.